The bond market is the backbone of all markets. That is a quote from Ray Dalio, one of the most profitable fund managers of all time, and yet most of us have never heard of it. Our education system never taught it to us. If you do not understand bonds, you do not understand your own money. It does not matter if you have $500 in a savings account or $500,000 in a retirement fund. This one market decides how far that money goes, not the stock market, not cryptocurrency, and definitely not whatever is trending this week. The average person knows those markets by name. Almost nobody knows the one that actually controls them, the bond market. It is a market most people have never looked at directly, and it's quietly setting the price of your mortgage, your car loan, your business financing, and your retirement account. Bonds are not boring. They're the thing everything else in your financial life is measured against. Today, I'm going to walk you through this step by step. First, I will show you exactly what a bond is. Then I will show you how its price and its return secretly work against each other. And by the end, you will understand why this one number changes how you should look at every financial decision you make. So let's start right where I promised. What actually is a bond? Right now, somewhere in the world, a government, a company, or even your own city or state needs money. Maybe to build roads, expand a factory, fix a bridge, or build a new school. Instead of asking a bank for a loan, it goes straight to regular people like you and says, lend me your money and I will pay you back with interest. That is a bond. There's actually an old-fashioned word for this, an IOU. That's really all a bond is, dressed up in financial language. You lend money, they agree to hand it back with a little extra added on top by a specific date. Now, before we go any further, this is important to understand. You do not need to own a single bond for this market to control your life. It affects how much your mortgage costs. It affects whether your business can get a loan. It affects how your retirement account performs. It affects whether the stock market goes up or down this year. It can even affect whether your job is at risk, since expensive borrowing everywhere at once can mean companies hiring fewer people and making more cuts. You can go your whole life never buying one bond, and it will still shape almost every financial decision you make. This is not about whether you invest in bonds. It is about understanding the machine that prices everything else. So let's open up that machine and actually look inside it. Time to actually get into how a bond works, one piece at a time. I'm going to use one single bond as our example, and we'll stick with this exact same bond the whole way through, so nothing gets confusing later. Every bond is made up of 5 parts. Let's go through them one by one. Say you lend the government $1,000 for 10 years. The first part is called the principal, sometimes called the face value. That's simply the $1,000 itself, the amount you're owed back at the end, no matter what happens in between. Don't confuse this fixed number with what you might actually pay to buy the bond or what you get if you sold it early. That's coming up in a moment. The second part is called the coupon. Each year, the government pays you a fixed amount of interest. Let's say that's $50 a year. $50 is 5% of your $1,000. So this bond has what's called a coupon rate of 5%. That fixed yearly payment and the rate behind it is the coupon. The third part is called the maturity date. 10 years from now, on the day they're due to return your money, that's the maturity date. That's when you get your full $1,000 back on top of all the yearly payments you already collected. The fourth part is called the price, and this is where most people get confused. So stay with me. You'd assume you always pay exactly $1,000 for a $1,000 bond. You don't. Bonds trade just like stocks. Investors buy and sell them every single day, and the price moves up and down depending on how badly people want that bond. The fifth part is called the yield, and this is the one that actually matters most. There's a difference between the coupon and the yield. The coupon is fixed, it never changes. The yield tells you the return the bond offers relative to the price someone pays for it. There are different ways to calculate yield, but for this example, we are using the current yield. the bond's yearly payment divided by its current price. Right now, since you paid the full $1,000 for this bond and it pays $50 a year, its current yield is exactly 5%, the same as the coupon rate. One thing worth flagging early. That 5% is based on the price paid for this particular bond. But you will also hear people talk about market yields, meaning the returns that bonds across the market are offering at a particular time. Those market yields are pushed around by outside forces. More on that soon. Now, you might be wondering how a bond's price could ever be anything other than the $1,000 you paid for it. The answer starts with where bonds actually come from. Every bond starts somewhere. When a government or company first creates one, that is called the primary market. That is the moment your $1,000 actually goes to them. Governments usually sell these at auctions. Big buyers like banks, pension funds, and even other countries bid on them, and how eagerly they bid ends up setting the yield for that entire batch of bonds. Ordinary people can buy in too, directly or through a fund, right alongside those larger players. After that first sale, you're not locked in for the full 10 years. You can sell your bond to another investor instead. That is called the secondary market. Think of it a little like reselling a concert ticket. The ticket still says the same seat and the same show, but what somebody is willing to pay you for it today depends entirely on demand right now, not on the number printed on the ticket. Your bond's coupon and its face value stay fixed, printed, and unchangeable. Its market price does not. Now that you know a bond can be bought and sold before it matures, this is where it gets interesting. Let's look at how the price and the yield actually move against each other, because this is the part that quietly controls your mortgage. Let's say interest rates rise, so new bonds start being issued that pay 6% instead of 5. Suddenly your old bond, still only paying $50 a year, looks a lot less attractive. Nobody wants to pay a full $1,000 for a bond that pays less than what is available right now. So the price of your bond drops. Maybe it falls to $900. For you, the existing owner, that means the bond you bought for $1,000 can now be sold for only $900. If you sell it, you lose $100. But now look at it from the new buyer side. That buyer pays only $900 and still receives the same $50 yearly payment. 50 divided by 900 is about 5.5%. That is the bond's current yield. The new buyer receives a higher yield because they paid a lower price for the same $50 payment. Your own return on the $1,000 you originally invested did not suddenly increase. The higher yield belongs to the person buying the bond today for $900. Now flip it. Say interest rates fall, so new bonds start paying only 3%. All of a sudden, your old bond, paying $50 a year, looks incredible by comparison. Everybody wants it. So the price climbs maybe to $1,100. For you, the existing owner, that is good news. You bought the bond for $1,000, but you can now sell it for $1,100. If you sell it, you make a $100 profit from the increase in its price, but the new buyer must now pay $1,100 to receive the same $50 yearly payment. 50 divided by 1,100 is about 4.5%. That is the bond's current yield. The buyer is willing to pay more than the $1,000 face value because this bond still pays $50 a year, while a new bond paying 3% would pay only $30 a year on $1,000. The buyer will collect those higher yearly payments before receiving the $1,000 face value at maturity. So the higher price creates a profit for the existing owner who sells, but a lower yield for the new buyer who pays that higher price. This is why high yield does not automatically mean high profit, and low yield does not automatically mean low profit. Yield tells the buyer how much return the bond offers relative to the price paid. Profit or loss tells the existing owner how much they make or lose if they sell compared with what they originally paid. This is the whole secret, and I want you to remember it. When interest rates rise, existing fixed rate bond prices fall. When interest rates fall, existing fixed rate bond prices rise. Price and yield move in opposite directions. This actually matters to you for a simple reason. If you already own bonds, whether directly or tucked inside a retirement account or a fund, this is exactly why their value can quietly rise or fall, even though you haven't touched a thing. Rates move somewhere far away, and the ground shifts under money you thought was just sitting still. The reassuring part, though, is this: that rise or fall only becomes real if you actually sell. If you hold your bond all the way to its maturity date, none of this touches you. You still collect every coupon payment exactly as promised, and you still get your full principal back at the end, whether the price wandered up to 1100 or down to 900 along the way. The only person who actually loses money from a price drop is someone who sells before maturity at that lower price. Everyone else is just watching a number on a statement move, not losing anything real. So now you know what a bond is, how its five parts work, where it comes from, and how its price and yield move together. Now you can see why any of this actually touches your life. Government bonds, especially the ones issued by the United States Treasury, are treated as close to risk-free as an investment gets. The government can always raise more money to pay you back, so investors generally trust they'll get theirs. That risk-free yield, the bigger one I mentioned a moment ago, not any single bond's own yield, becomes the ruler that measures every other investment on earth. If the government will pay you 5% guaranteed, doing absolutely nothing, then any other investment better be offering you something worth the extra risk. Otherwise, why would you bother? To be fair, risk-free doesn't mean risk-free in every sense. Inflation can still quietly eat into your real return. Rates can still move against you if you're forced to sell early. And when your bond finally matures and hands your money back, whatever you reinvested in next might only pay a lower rate than this one did. Nothing in investing is completely free of risk. Treasuries are just about as close as it gets. There's a natural question here. Who actually decides how high or low that rate sits? It's probably not who you'd assume. It's tempting to say the Federal Reserve just sets all of this directly. That's not quite true. The Fed controls short-term rates, the ones banks charge each other overnight. Longer-term rates, the ones behind almost every example we're about to cover, are shaped by a mix of things: what investors expect inflation to do, how fast the economy is expected to grow, and how much the government needs to borrow. The Fed influences the weather. It doesn't control every raindrop. Now that you know what this ruler is and who actually moves it, let's look at the 5 major places in your life where you'll actually use it. Here's the first place: evaluating any investment opportunity that comes your way. This shows up in small moments, not just big, exciting ones. If someone offers you 6% on something that isn't guaranteed and Treasury bonds are already paying 5% for doing nothing, you're really only being paid one extra point for the risk. Sometimes that's worth it. Often, once you actually look at it side by side, it isn't. The bigger the number gets, the faster people forget to ask that question at all. Picture this: a friend calls you with an opportunity. Maybe it's a rental property, maybe it's a stake in a small business, maybe it's a cousin's startup that's finally ready to raise money. They tell you it should return about 10% a year. On its own, that sounds fantastic, but the real question is never just how much can I make? The real question is, how much more am I making compared to the safe option that's already sitting in front of me doing nothing but existing? If Treasury bonds are paying 5% with basically no effort and no risk, that 10% opportunity is still a 10% opportunity. But only 5 percentage points are the extra return above what you could have earned for doing nothing at all. Now, ask yourself honestly, is that extra 5% worth the risk of losing your money entirely? Is it worth having your cash locked up for years with no easy way out? Is it worth the stress of checking on it, the time you'll spend managing it, and the sleep you might lose if it goes sideways? I'm not telling you to avoid every opportunity that isn't guaranteed. Plenty of good investments come with real risk attached, and that's completely fine. What I'm telling you is to always know your baseline first before you say yes to anything. A bigger number is not automatically a better decision. Call it the higher number trap. It's the mistake that quietly ruins portfolios and friendships with cousins. People get excited about the percentage on the label and forget to ask what they're actually being compensated for. Here's the second place, and it's one you already deal with: your mortgage. The interest rate on your mortgage isn't some random number your bank decided to charge you out of nowhere. It's closely tied to the yield on a specific government bond, the 10-year treasury. When that yield climbs, mortgage rates climb with it. When it falls, mortgage rates tend to ease. Just to be clear on what this actually touches, if you already have a fixed rate mortgage, your rate is locked in and it won't move just because yields do later. This is about the rate you get offered the moment you take out a new loan or the moment you refinance an old one. Every single time somebody applies for a mortgage, this is the number quietly shaping what they're offered that day. Let's make this real with actual numbers, because this is where it stops being theory. Say you're borrowing $300,000 for a 30-year mortgage. At a 4% rate, your monthly payment lands around $1,432. At a 7% rate on that exact same loan for the exact same house, your payment climbs to almost $2,000 a month. That's an extra $560 every single month. Over the full 30 years, the difference adds up to more than $200,000. Nobody changed the price of the house. The only thing that moved was a number sitting quietly in the bond market, thousands of miles away from your kitchen table. Here's the third place, and it reaches further than you'd expect: how businesses borrow to grow and how that ripples straight back to you as a customer. The same ripple that hit your mortgage runs through business loans, auto loans, and eventually even credit cards. Say you own a small bakery and want to buy a second oven so you can finally take on more orders. When borrowing is cheap, that loan is an easy yes. When borrowing gets expensive, that same oven suddenly means a monthly payment that eats into a much bigger slice of your profit, so the expansion gets pushed back another year and another customer keeps waiting for a table. Multiply your one bakery by every small business trying to grow at the same time, and you start to see how one bond yield can quietly slow down an entire economy. There's a flip side to this too, and it shows up on the customer's end, not just the business owners. When borrowing gets expensive, people don't just take out fewer loans. They also quietly cut back on whatever isn't strictly necessary. A haircut gets stretched out a few extra weeks. A gym membership becomes the first thing canceled. The businesses selling those kinds of extras often feel the squeeze before almost anyone else does, not because their product got worse, but because their customers' spare cash quietly shrank the moment borrowing costs rose. It reaches bigger purchases too. A family that was about to buy a house might decide to wait another year. Someone who needed a new car might keep the old one running a little longer than they planned. A kitchen renovation that felt easy to finance last year suddenly feels like a stretch this year, on the exact same project, at the exact same price tag. None of this is really about willpower. It's about the monthly payment quietly becoming less affordable on the exact same purchase because the cost of borrowing changed underneath it while nobody was looking. Here's the fourth place, and it's a little more indirect but no less real: the stock market. Let's start with the actual difference between owning a stock and owning a bond, because that's the foundation for everything else here. Imagine a small coffee shop down the street. If you buy stock in that coffee shop, you own a slice of it. If business booms, your slice grows in value, and you might even get a small cut of the profits paid out to you along the way. If business collapses, your slice shrinks right along with it. You're an owner, for better or worse. Now imagine instead you simply lent the coffee shop some money to buy new espresso machines. You don't own any part of the shop. If it becomes the hottest spot in town, you are still only owed your money back, plus the interest they promised you. That's a bond. And if that coffee shop ever goes under, the people it borrowed money from generally get paid back before the owners see a single cent. It's easy to walk away thinking every bond is automatically safe just for being a bond. It isn't. Lending to the government is about as safe as lending gets. Lending to a small, struggling business is a completely different animal, and it can lose value or go unpaid, the same as any other loan can. Being a lender instead of an owner lowers your risk. It doesn't erase it. Owning is riskier than lending, so investors expect stocks to pay them more over time than bonds do to make that extra risk worth taking. That's really all the phrase equity risk premium means, even though it sounds complicated. It's just the extra reward investors want for accepting more uncertainty. That's exactly why it matters for the stock market as a whole. When treasury bonds are paying well with zero risk, some investors look at stocks and ask themselves why they bother taking on the risk when the safe option already pays this much. So some money stays parked in bonds instead of flowing into stocks, which can quietly hold stock prices back. When treasury yields drop, the safe option stops paying much, so that same money goes looking for better returns, often landing in stocks, sometimes even cryptocurrency, and pushing prices up. Worth noting, this is a tendency, not a rule carved in stone. Stocks can still climb even while yields are high if a company's profits are strong enough to make up the difference. But now, when you hear that stocks drop because bond yields spike, you'll actually understand what that sentence means. Here's the fifth and final place, and it's the one almost everyone eventually thinks about: retirement. This applies whether you're already retired or still working toward it. So let's start with someone already living off their savings. Say someone just retired with a modest nest egg. If safe, high quality bonds are paying well, they can generate real steady income without touching risky investments at all. Their money quietly does the work for them. Now picture that same retiree in a world where yields are low. Suddenly, the safe option barely pays anything, so to generate the same income they need to live on, they have to reach further into riskier investments, the kind that can swing wildly in bad years, right when they can least afford a bad year. If you haven't retired yet, this still applies to you just earlier. You might reasonably lean more heavily into stocks for growth while you're younger, and that's perfectly fine. But it still helps to know the safe benchmark you're being measured against today, because one day that benchmark becomes your floor too. There's a general pattern that follows from all of this. The closer someone gets to retirement, the more their portfolio tends to shift toward bonds and away from stocks. A younger investor has decades to recover from a bad year in the stock market. Someone about to retire doesn't have that kind of time. So a downturn right before they need the money can do real damage. This is exactly why so many retirement funds are built to automatically shift toward more bonds as the target date gets closer. Worth knowing, this isn't a strict formula everyone agrees on. Some people follow rough guides based on age, while others lean more towards stocks well into their 60s, since retirements can now last 30 years or longer. The general direction holds either way. Leaning more toward bonds as retirement nears is common, sensible advice. The exact mix is something worth deciding with real thought, not just a rule to memorize. Beyond any single decision, there's one more habit worth building, and this one has nothing to do with your age. Every so often, step back and look at your whole portfolio, not just one new pitch someone hands you. Ask the same question you'd ask about any single opportunity, but ask it about everything you're already holding at once. Stocks, bonds, real estate, all of it together. A mix that made sense 5 years ago doesn't automatically still make sense today, and the only way to catch that is to actually look. One more piece of this puzzle is left, where all of this borrowing actually starts. The government itself. Governments almost never collect enough in taxes to cover everything they spend, so they borrow the difference by issuing bonds. The buyers on the other side of that trade are banks, pension funds, insurance companies, and foreign governments. Ordinary savers buy in too, sometimes without even realizing it, since plenty of retirement accounts hold treasury bonds quietly in the background. To give you a sense of scale, in fiscal year 2025, the United States government spent about $1.8 trillion more than it brought in. Net interest costs reached about $970 billion, more than the government spent on national defense that same year. I'm not going to turn this into a debate about politics or blame. That's not what this is about. What matters for you is simpler. The government's total debt compared to the size of the entire economy now sits above 120%. Imagine a household that owes more than a full year of its own income, and that gap is slowly getting wider instead of smaller. When older, cheaper debt comes due and has to be replaced at today's higher rates, the cost of running the government goes up. And when that cost rises, it eventually shows up as pressure, whether through future taxes, spending cuts, or more borrowing. You don't need to have an opinion about who's responsible for that. You just need to understand that this is one more reason bond yields don't sit still, and one more reason this market deserves your attention. So, to sum it all up, a bond is simply a loan. Governments and companies borrow money from investors, promise to pay interest, and return the principal on a specific date. Every bond has a face value, a coupon, a maturity date, a price, and a yield. The coupon stays fixed, but the market price can change. When the price rises, the yield falls. When the price falls, the yield rises. Treasury yields become the benchmark against which other financial decisions are measured. They influence what you pay for a mortgage, what businesses pay to borrow, how attractive stocks appear, and how much income retirees can earn from safer investments. So before you accept a loan, check whether borrowing costs are climbing or easing. Before you accept an investment opportunity, compare its potential return with what safer bonds are already paying. And before a major movement in the stock market frightens you, look at what happened to bond yields. At the beginning, I told you what Ray Dalio said: the bond market is the backbone of all markets. It sounded like a strange thing to say about something most people consider boring, but now you have seen why he said it. You do not have to buy a single bond in your life for the bond market to affect your mortgage, your investments, your retirement account, your business, and even the wider economy. I also told you that it does not matter whether you have $500 in a savings account or $500,000 in a retirement fund. Two people can have the exact same amount of money sitting in the exact same kind of account. One understands why their mortgage offer came in the way it did, why their portfolio moved last quarter, and why that investment return was not quite as generous as it first sounded. The other simply accepts the number on the page and hopes for the best. Same money, same starting point, completely different understanding of what happens to it next. The people who build lasting wealth are not always the ones who discovered a secret everyone else missed. They're often the ones who finally stopped ignoring the boring number that had been influencing everything else the entire time. Now you understand it too. If this video helped you finally understand bonds, subscribe to Ayana Finance for more clear, practical videos about money and building lasting wealth. Thank you for watching.